You're listening to A Book with Legs, a podcast presented by Smead Capital Management. At Smead Capital Management, we advise investors who fear stock market failure. You can learn more at smeadcap.com or by calling your financial advisor.
Welcome to A Book with Legs podcast. I'm Cole Smead. I'm the president and a portfolio manager here at Smead Capital Management. At our firm, we are readers and book junkies. It can be said that leaders are readers, and we believe books provide us a great source of information for filtering what is and isn't important for us as investors. Investing is the last great liberal art and the best way to spend a lifetime of learning. This podcast is for readers, thinkers, business-minded people, and investors who want to grow their knowledge from great authors and their writing. Charlie Munger often talks about using multiple mental models and analysis. Our aim for this podcast is to help listeners test Munger's theory in businesses, markets, and people. We're glad everyone has joined us for this episode. We're going to talk and think about a great framework for investors, businesses, and the global economy. Kevin Coldiron is joining us to talk about his book, The Rise of Carry, that he co-authored with Tim Lee and Jamie Lee. Kevin is a lecturer at Cal Berkeley's Haas School of Business and the owner of Rockridge Capital. Prior to that, he founded and was co-CIO of Alger Coldiron Investors. He received his MBA from London Business School and a BS in finance with a minor in economics from Penn State University. Kevin, we're excited to talk with you. We were working on a hiring for a role here at our firm at Smead Capital, and your book was mentioned in that process, and that's how we really came across it. So first off, thank you for joining, and kind of love to open up our time by just asking, where did this book emanate from? How did your work with Tim and Jamie all come about?
Yeah, first of all, thanks, Cole, for having me on. I really appreciate it. And the book got, I guess from my perspective, I ran a hedge fund firm for many years called Alger Coldiron Investors. We were a quantitative equity firm, so we used basically computer models to take long and short positions, and we tried to structure portfolios that were market neutral, so generating alpha regardless of the market environment. Tim Lee ran a economics consulting firm, so he had hedge funds as clients. What was interesting is that most of his hedge fund clients were kind of global macro funds because he wrote about the global economy, and his clients were people who took bets on interest rates and currencies, things like that. We didn't do that, but I really liked Tim's framework for thinking about the world. So we were clients of his and used his ideas more as kind of risk management. And he had been talking about carry and carry trades going all the way back to 2006 when the yen carry trade really got started. And we can talk more about that in a second. But anyways, so roll forward for 5 or 6 years, I ended up selling my stake in that business in 2014, got in contact with Tim and said, hey, all the stuff you've been writing about carry over the years, I think would make a great book. And he's like, well, interesting you say that. I'm actually starting to think about writing that with my son, Jamie, who is a volatility trader. And so the three of us ended up collaborating, and I'm honestly just thankful for those guys of, including me in their project. And what was nice about that collaboration is that Tim brings a macroeconomist perspective. Jamie brings kind of like the micro perspective of someone who's traded in the volatility markets. And then I'm someone who's kind of sits in between. I understand the kind of, the plumbing of markets, having run hedge funds. I understand the institutional incentives. And I also understand what it's like to be running a levered strategy when carry trades unwind. So that's kind of how we got together and what we bring to the party.
So can you start, just to kind of make sure we have, the core, kind of the core issue that you spend a lot of your time book, kind of expanding on for the framework. Can you start by just explaining a traditional currency carry trade so that our listeners understand that seed?
Absolutely. Yeah, carry kind of evolved or it had its origins in the currency market. So the classic currency carry trade is you borrow in a low interest rate currency. Let's call it the dollar. So you borrow US dollars at a low interest rate, and then you convert that to a currency with higher interest rates. Let's call it the Turkish lira. So if Turkish lira interest rates are 10% and US dollar interest rates are 1%, you can borrow dollars at 1%, convert them to Turkish lira, put them in a bank in Turkey, and you earn 10%. If the exchange rate doesn't change, right, you can basically earn that yield difference, earn that spread. And that spread is called the carry. That's the return you earn on that trade if the world stays the same. If the exchange rate stays the same, you can convert your Turkish lira back to US dollars, say in a year's time, you've earned a 9% return.
Okay, so now using, like you said, you come at this from an equity markets perspective. What, in your career, what do you think is the big kind of currency carry trades that you witnessed?
There's been different currency carry trades prevalent at different points in market history. The big one was in the kind of run up to the creation of the euro, where, prior to the creation of the euro, obviously you had different interest rates across all the currencies in Europe. So you typically had the Italian lira with high interest rates, the UK pound, even countries like the Scandinavian countries we now think of as almost kind of safe havens, but historically they had quite high interest rates. So you had trades where you could borrow in, say, the Deutschmark, German mark, invest in Italian lira, invest in British pounds or Norwegian krona, I believe. And as the movement toward the euro gathered steam, interest rates in Europe converged, and so that became a very profitable trade as currency markets stayed stable and you kind of earned that spread. After the euro, the carried trade sort of moved on to two different sources. One, the Australian dollar, and to some extent the New Zealand dollar. That's a much smaller market. Both of those are developed market currencies with traditionally higher interest rates. And then emerging market currencies, Brazilian real and Turkish lira, South Africa, emerging markets with much higher interest rates. So I'd say in the last 20 years, the majority of currency carry trades have been into emerging markets because developed market interest rates are now so close together.
Sure.
The other thing, Cole, that I would mention is that I alluded in the introduction to the yen carry trade. So if you remember, the Japanese market had a crash in the late 1980s, and Japan was kind of the first country to move to ultra-low interest rates. So for a long time, the funding currency, the currency you would borrow to finance carry trades, was the Japanese yen, because interest rates there were so much lower than in other countries. And now, of course, interest rates are low in basically everywhere in the developed world. So you can fund just as easily in the US dollar as you can in the Japanese yen.
Yeah, and I think who probably explains the best story of the fallout of that carry trade is Ed Chancellor's book, Devil Takes the Hindmost, because he explains how a lot of that got cleaned up. So can you, early in the book, you explain what the characteristics of a carry trade are. What would you explain the primary characteristics are?
Yeah, that's where we start off, and that's quite important. So there's 4 primary characteristics of carry trades. First, they always involve leverage. So it always involves either explicitly borrowing money or kind of a shadow leverage, which we could talk about later on. But so carry trades always involve leverage. They are what we call liquidity providing. So they essentially channel money from where there's an excess to where there's a dearth. Basically taking, let's say in the case of Japan, an economy that had a lot of capital and channeling it to Turkey or Brazil or South Africa, countries where there's a dearth of capital. So it's a liquidity providing trade. And that's important because as carry grows globally, that means markets seem like they're more liquid. Liquidity grows. So that's the second characteristic. Third characteristic is that carry trades are what we call short volatility. They make money as long as the world stays the same. It's a trade that makes money if nothing happens. So it's a bet on stability. When the world is stable, carry trades profit. When the world becomes unstable, carry trades can lose money quickly, which brings us to the fourth characteristics, which is this kind of escalator up, elevator down return pattern. Long periods, fairly steady, but modest profits, punctuated by occasional big drawdowns.
You explained in parts of your book what transpired in 1998 with long-term capital management. My best way of framing that story and that period was I think it was Lowenstein who wrote When Genius Failed. That was 24 years ago. I mean, I'm 38 years old, Kevin. Most millennials can read about it, but they couldn't experience it, for better or for worse. Can you explain what transpired in that carry trade ending and kind of some of what were the characteristics and the liquidity and those kind of things of that problem?
Yeah, so I'm slightly older than you. I won't reveal my true age, but roughly 2 decades older than you. So long-term capital was... this, you have to remember, this is a world where hedge funds were not part of the mainstream at all. To the extent hedge funds existed, they were mainly kind of, not the shadow exactly, but you didn't have much information. They were mainly vehicles for people, very high net worth individuals to manage money. Long-term capital was the first kind of quasi-institutional fund started by a group of Salomon Brothers traders, John Merriweather being the first one, or being the most prominent one. And they were the gold standard of hedge funds at the time. And essentially what they did, it was just a basket of various types of carry trades. They did currency carry trades like we just described. They did carry trades in the fixed income markets where you would look at, basically bonds that had very similar cash flow characteristics, but one would be trading at a slightly lower price than the other. And so they would just go long the slightly higher yielding bond and short the slightly lower yielding bond. And that difference in yield was the carry, but the yield was so small that they had to apply lots of leverage, 10, 20, 30, 50 times leverage to get to a decent absolute return. So the long-term capital was a basket of various types of carry trades, all with the characteristics that we just described, the important one being short volatility. So they made lots of profits in the years leading up to 1997. And then there was a crisis in East Asian currencies. So high-yielding currencies in Malaysia, Thailand started to depreciate. So long-term capital would have been, long those currencies or long, carry trades in those currencies, and those carry trades started losing money. Eventually, it kind of spilled over into Russia, where they also had borrowed money to invest in higher-yielding Russian bonds. And so because they were applying so much leverage, when you start losing money in a levered trade, you need to close out those positions, otherwise you can get wiped out. And if people see you coming, they know you have to trade, they move the prices against you, and you can quickly get into a vicious cycle, which is exactly what happened. And long-term capital in a very short period of time essentially went bust. From a market's perspective, the key thing is that the Fed got together with basically the lenders to long-term capital, and the Fed didn't directly intervene to stabilize the markets, but it basically told the lenders to long-term capital, look, you need to organize essentially a private sector bailout. You need to take over their book and unwind it slowly. And then subsequently, the Fed lowered interest rates. So it wasn't a direct intervention the way we saw in 2008 or 2020, but it was the first signal to the market that when carry trades blow up and it creates a potential systemic risk, the central bank was going to do something to prevent kind of broader contagion.
And that's a great point. That's a fantastic point, Kevin. And I think I want to come back to that because I think the later parts of your book really, we can kind of dive into the weeds of that for better or for worse. So let's pivot. And where I want to pivot next is you explain that carry trades are like selling insurance. When I read this, I think of Warren Buffett. When I think of selling insurance, can you explain what you mean by carry trades are just like insurance?
If you think about what the cash flow profile of someone who's selling insurance, what does it look like? Well, if I sell you an insurance policy, Cole, every month you pay me a premium, right? And so I have steady premium income from you. And then once in a while, let's say I've sold you, fire insurance. I get 10 years of premium income, and then in 10 years you have a fire and I have to make a big payout. So there's steady income punctuated by occasional big payouts. Now, and that's exactly what the profile of a carry trade looks like. You think about, going long the Turkey, borrowing in yen and going long the Turkish lira. You earn that interest rate spread month in, month out. But if something happens in Turkey and there's a sudden depreciation in the currency, you can have a very big loss. So you can see how those two return profiles are very similar, hopefully, from the example. Now, the difference is that in the insurance world, the regulated insurance world, right, you have to demonstrate that you've got capital to make those payouts, right? I have to show the regulator that if Cole's house burns down, I've got the money to pay him. So the existence of that kind of insurance makes us all better off, right? You're able to buy insurance on your house. Therefore, you don't have to keep a lot of cash in the bank in case your house burns down, right? You've got that. So I've kind of created liquidity for you in that sense because I've allowed you to reduce the amount of cash you need and use it in other ways. And I've made you better off, and I've made me better off because I'm making some money out of it. So the world's kind of, and we try to emphasize this in the book. The world needs carry to some extent, and that kind of regulated, well-structured carry is good. But in the financial markets, you don't have to show that you can withstand a carry crash. Long-term capital, as it turned out, didn't have enough capital to withstand a carry crash. And so when in the financial markets, carry traders go bankrupt, it can have this contagion effect because their lenders can lose money and it can sort of spiral.
Yeah, to your point, when I buy insurance on my car, since I mentioned Buffett, using Geico as an example, Geico is effectively long me not hurting myself or damaging my car, which is a good thing, right? They're taking me as a good driver, hopefully, versus trying to bet that financial markets stay sane is a little tougher to model. So you talk about the agents of carry, and you explain a few groups that I'd love to kind of have you peel back a little bit. I think I only used 3 of them, but so you mentioned, hedge funds have kind of become a player in such a way that they weren't in a prior era. As an agent of carry, if they're becoming bigger and bigger and bigger, doesn't that just beget more volatility just by the nature of the pie they touch?
When you say beget more volatility, are you saying
in other words,
that
they're risk-taking groups by nature in a way that other pools of capital might not be, right? In other words, there's a incentive structure that causes them to seek out risk in a unique way. And obviously, like you point out, all carry trades end, or all carry regimes ultimately end. If they're becoming a much larger financial player from, say, 1980 to 2020, doesn't that financial risk-seeking profile really increase volatility in the long run?
I guess it has. In the long run, I think it does. In the short run, to the extent they're engaging in carry trades, it kind of dampens volatility. So you get 2 things going on. So if hedge funds, so what we say in the book is, look, the way people get paid in hedge funds, and I understand this because I was a hedge fund manager for a long time, is you get an annual incentive fee based on the profits, right? Typically 20%, I guess now maybe 15% of the profits you earn for your clients, you get to keep as an incentive fee. So carried, if you think about the structure of a carry trade, going back to our insurance example, you get regular income with occasional big losses. So if you're engaging in carry trades, you're earning regular profits. So, you're regularly collecting an incentive fee because you're making profits. And then once in a while, you're going to have a big drawdown. You're going to lose a lot of money. Those big drawdowns tend to come, when there's a market disruption. So you're losing money at the same time everyone else is losing money. It's easy to blame that on the market. So individual traders, individual hedge funds have an incentive to take on carry trades because they're collecting these incentive fees regularly, and they don't have to give them back when they have a drawdown. The flip side is it would be very difficult in a hedge fund world as a trader, as a manager, to be negative carry, to basically be buying insurance and having to pay out money every year. You're not going to attract investors if you lose money 9 out of every 10 years, right? That's a hard profile. So as hedge funds have grown, I think what's happened is they naturally gravitate toward carry trades. So as they engage in carry trades, it's kind of like they're selling volatility, and that has the effect of pushing down volatility in the short term until there's some event, some spark. And then all of a sudden you've got a lot of people who are potentially losing money. And so the drawdown gets reinforced. So you get a lot more skewness in returns, a lot bigger negative realizations now than you did prior to, say, 1998, because you got a lot more people trading, being in the carry trade in all its various forms.
You talk about sovereign wealth funds as very natural carry, participants. Explain the characteristics of them that make them so unique.
Yeah, in the probably the classic, you brought up Warren Buffett, right? He's a carry trader, right? He's selling insurance, and he's in a good position to do that because Berkshire Hathaway has a very strong balance sheet, so he can survive these drawdowns, right? So he's in a position to ride out the drawdowns, and sovereign wealth funds are kind of in a similar position, right? They're basically large pools of reserves that have been built up either in countries that have trade surpluses like China, or commodity exports like Russia and other countries that have consistent surpluses. And so they've had very strong balance sheets, and therefore, they're in a position to, if they want, to sell volatility because they can ride out market storms and earn the premium. If you think about some of the bigger well-funded pension plans out there, a lot of the Canadian pension plans are very well-funded, and they engage in volatility selling and carry trades precisely for this reason, because they know that they can ride out a drawdown. They've got very long-term liability profiles, and they're well-funded. They're not going to be forced to close out positions during a spike in volatility. So, people with strong balance sheets are the natural providers of insurance services, of liquidity services to the market. Hedge funds do not have strong balance sheets, right? Their liabilities are short term. People can take their money out every month or every quarter. So they're not in a position to ride out carry crashes, which is why they can become a destabilizing force if they're doing carry trades in large amounts.
And to follow on that, you also mentioned private equity firms as an agent of carry. Obviously, it's very different than a sovereign wealth fund or insurer, and it's in some respects more like a hedge fund. But explain what you mean by the carry that private equity can take on.
Yeah, private equity, you think about what they're doing at a very high level. They're typically buying firms that have solid cash flows, so solid kind of streams of income, but for whatever reason, the market's not assigning, what they think is a fair value to those cash flows. It could be that they're in an industry that's, out of favor, maybe for ESG reasons or whatever. So what private equity firms will do is borrow money and use that to take over those companies. So they're borrowing money at a lower interest rate than what they think they're getting on the equity that they purchase. So that's the definition of a carry trade. They're using borrowed money to earn a higher yield. Now, their positions aren't marked to market in the way a hedge fund is, right? So
Sure.
when there's volatility erupts, they aren't necessarily forced sellers unless the people who've lent them money, believe that they're not going to get paid back, in which case, like in 2008, some private equity firms got in trouble and they had to liquidate some of their holdings. But they're definitely a source of carry, kind of a longer term source, taking borrowed money and channeling it into kind of higher yielding companies, higher yielding equity holdings.
And they need the liquidity, obviously, at some point. So a lot of the elements, like you said, of carry, follow on. And there's, the Sawtooth Pattern, which occasionally they borrow too much, and on their small equity investment, they just have to give it up every once in a while, which isn't common, I would note. But so Kevin, let's go to the real fireworks, because later in your book, I just couldn't have had more fun thinking about this framework. So you explain what you call a carry regime. And I think this is like, if someone says, where's the meat and potatoes? This is awesome. You start out first by asking, quote, is the carry regime a natural phenomena or a product of central bank policies? What does your work provide for an answer to that?
There's some level of carry in the financial markets that's natural and good, right?
Mm-hmm.
We talked about insurance being a potential source of good, and banks are carry traders, right? Just what do you do when you put your money in a deposit? You get paid an interest rate that's lower than what the bank earns on its loan portfolio, right? That's a carry trade. So the existence of banks is also a good thing, right? It allows credit creation in the economy. So carry, in a world of kind of a world of free capital, is going to exist, should exist, and is good for all of us. But it has attendant risks, and those, like any market where those risks get distorted, it's going to create follow-on problems. So to the extent that in a carry crash, people who, if you will, should have gone bankrupt are bailed out or don't lose as much money as they otherwise would have, then what's that going to do? That's going to encourage more people to do that trade, to do that transaction, which means that the next time volatility erupts, more people are going to get into trouble, therefore necessitating a greater intervention, which in turn encourages still more money to come into the carry trade. So we call this kind of a ratchet process, where the initial level of carry, really we think either starting in 1998, when there was an indication that, hey, when carry traders get in trouble, there's going to be some backup, either in the form of lower interest rates, which we saw in 1998, or in a unofficial or official bailout. And so the carry regime is a world where a kind of cycle is developed that's encouraged the growth of carry because of the actions of central banks, which I'm not like an anti-central bank guy. I think when you look at the choices that they thought they were making at the time, it's always, hey, let's deal with the problem now, and then we can deal with systemic impacts later on. But they never do that, and so you just have a kind of greater and greater role for central banks in the economy during the carry regime.
So to focus a little bit more in on the natural phenomena idea, what I thought about in reading that, Kevin, is let's call spades spades. Humans love easy money. Okay, so if I can borrow it too and make 8, we call that easy money. Okay. And so what happens is, you're at a cocktail party like Peter Lynch says, and someone starts telling you about their easy money. So for example, easy money was, '06. You're in Phoenix, Arizona. Look how easy it is to make money in housing, for example. Those are carries, like you're pointing out. And that was a regime, I would argue too, to your point. And so isn't it just kind of the psychological, would you consider that to be kind of the natural phenomena, the easy money that humans love to fall in love with at these certain junctures?
I think that's certainly part of it. If you think about kind of what's happened in the world where I started my career in the late 1980s, China was not part of the global financial system. A lot of these emerging markets were uninvestable. Even Europe, as I said, was split up into different currencies and it was expensive to trade. So capital markets were not integrated nearly to the same extent they are now. Trading was a lot more expensive. So these carry trades were out there, but not easily accessible, right? You could have a few people who really had expertise who could do them. But as markets have become more integrated, capital flows freed up, technology and data became cheaper. All these things come together to make these various carry trades much more accessible. And the pools of capital out there, as we've talked about, that can quickly find them and act on them are much greater. So that kind of institutional background has made it much easier for financial market participants to engage in carry. And as you said, I think your example of the Phoenix property market is great. I mean, we talk about buy to let property as a carry trade, and we see that everywhere. My wife's a New Zealander, and that the property market there is heavily fueled by people borrowing to buy rental properties. So I do think it's like you said, the easy money phenomenon has now got to the point where when you hear a story at a cocktail party, it's possible for you to actually do something, whereas maybe 30 years ago you couldn't.
After you say that, I'm literally thinking Tom Petterfee needs to come on right after and start pitching. You can do all this through interactive brokers today.
Right.
You know what I mean?
Yeah.
And that shows you how the technology has really brought this in. So I want to follow one more step on this because I love this. So as you're building out this carry regime, you point out that numerous times in your book that when carry trades end, S&P 500 volatility spikes. In fact, I'll put out a quote here from your book on page 88. If there's a parallel between currency carry trades and stock market volatility carry trades, and it is clear both from the theoretical argument and from the empirical data that there must be, then it seems that the central bank policies may have been a malign influence on the latter too, end quote. This was to your earlier point. I take this to say, Kevin, that central banks often make the psychological overconfidence, the natural phenomena that we just talked about, worse. Is that what you're saying, in effect? They take it and they compound it to be far worse.
Absolutely.
Right?
Absolutely. They've so the whole phenomenon of buy the dip, right, is I think exactly what you're talking about. When volatility spikes, carry trade loses money, the S&P 500 does poorly. What central bank action has shown is that there's going to be support there. And so the natural thing to do is, when you see that, is to go in and buy the dip. And dip buying has been richly rewarded in the last couple of decades, to the extent that, if you're, say, someone your age, that's really all you've known in your career is dip
Correct.
buying work. So why wouldn't you do it? So yeah, I absolutely agree that central bank action has kind of reinforced that.
And we're going to come back to that because I think you got some great data in the book. So let me talking about the Sawtooth Pattern. And by the way, you stole the words out of my mouth, Kevin, earlier in our conversation. I had in my notes, I was going to say, you called it a sawtooth, and at our firm we call it going up on the escalator and going down on an elevator. So if that's the pattern that Sawtooth and carry trades, that's how they look. You mentioned Brownian noise, and why don't we see stock returns that follow a pattern that's more like that, where it's more independent?
Well, precisely for the reason that we've talked about, right? I think the prevailing idea when I was at business school many moons ago was that markets were efficient, and observing today's price told you nothing about the future, and so that would imply that stocks would have a kind of a somewhat normal distribution, but in a world of carry trades, in a world where we're short volatility, and the most important measure of volatility in the world is the S&P 500. You're going to get these big drawdowns, so you're going to get skewness, and that actually shows up quite clearly in the distribution of S&P 500 returns. If you plot kind of the daily returns to the S&P against a bell curve, what you see is that there's a lot more daily returns just to the right side of zero than there quote unquote should be. So those are the small, steady gains. And then there's a ton more on the far left, representing the outsized drawdowns. So we don't see the quote unquote Brownian motion, the independent returns, because the S&P 500 essentially become the global center of the carry trade.
Now, when you say that it's like kind of the ultimate carry trade, you're talking about the depth, the amount of capital it could suck in. As you pointed out, I mean, European markets don't have nearly the market cap. And I actually thought, as I was reading your book, I was thinking about companies coming to market, right? Well, where do they go to the market all the time right now versus other markets? It's the biggest carry trade, to your point. So volatility spiking.
Just to interrupt you on that,
Sure.
I did a presentation with Jamie about a year ago, and he puts together some graphs, and his point that he makes really well, much better than me, is that if you have a risk position anywhere in the world, you can hedge that with the S&P 500 futures or options markets. In other words, the derivative markets linked to the S&P 500 are many order of magnitudes bigger than anywhere else in the world. So I know people, who've told me, I got stuck holding a long position in South African equities from a client trade. I didn't want to have the risk, so I offset it by shorting an S&P 500 future. So the graph that Jamie did was showing the trading volume in the I think the E-minis in the U.S. In the S&P 500 E-minis, and I'm like, hey, I think the scale on your graph is wrong, because it's saying it trades something like $60 trillion in value a year, and that can't be right. And he's like, no, it's right.
I love it.
And then there's nothing else that compares. So the point is that you can the U.S. equity market, particularly S&P 500, is providing liquidity services to the rest of the world. If you have a risk position anywhere else in the world, you can hedge it. It won't be a perfect hedge, but you can hedge it in the S&P 500 markets. And in return for providing that service, there should be a compensation, which is kind of the carry. And so the S&P 500 markets have kind of evolved to being a carry trade by providing liquidity to the rest of the world.
And also, like you're pointing out, if you want to hedge, it's the cheapest way to insure. It's the low-cost producer of insurance too.
Exactly.
So, and by the way, as I was thinking about this, we own U.S. equities and also own non-U.S. equities. And it's funny, we still look at the S&P as the general risk proxy of equities, regardless of what market in the world. In other words, we comp it and say, how did it do relative to the S&P? Because like you said, it's the number one benchmark for any investor. So Volmageddon, you talk about Volmageddon and when volatility spiked. Now, volatility spiked, but the S&P didn't fall apart, kind of in like a, like VIX picking up should be kind of pointing to some kind of almost bear in a way. Why do you think that we didn't go to a nasty bear market with volatility doing what it did then?
Yeah, that's a fascinating case study. I think the initial trigger for Volmageddon was a big down move in the S&P 500, I think like a couple of percent, and we hadn't seen a big down move. This was early 2018, so the market had been on quite a strong run, and then you had like a 2% down day, and that triggered the initial rise in the VIX. But then once you had that initial rise triggered, then what happened was there were a number of kind of structured products linked to the VIX that ended up kind of going into a kind of a death spiral, a kind of an unfavorable trading spiral. So you had dedicated short VIX funds, short VIX futures. So basically, literally, hey, we're going to earn the carry by selling VIX futures. And obviously, when the VIX rose, then those funds started losing money, and they have to buy in VIX futures in order to reduce their exposure. And of course, as they buy VIX futures, as they close their short position, that pushes the VIX up higher, and you get this kind of negative spiral. Interestingly, you also had, this is kind of funny, you also had a lot of products that were levered long the VIX, because at that time volatility was kind of the lowest that we had really ever seen. And so there's people who are like, hey, we want to bet on mean reversion. We want to bet on the VIX going from 10 back to 20.
But the premiums climbed so quick, right?
Well, when the dynamics of running a levered long fund are such that if you're, and remember, this is an exchange traded product. So you had kind of like, the rule is you had to end the day with 200% levered exposure, right? So if during the day the VIX rises, what happens to your leverage? It actually falls, right? So you have to buy to maintain your target leverage. So ironically, you had dedicated short VIX funds having to buy to cover their shorts, and you had levered long VIX funds having to buy to maintain their target leverage. And those two things, combined with the positioning of dealers who had sold calls on the VIX, and therefore they needed to buy VIX to hedge their exposure, all those three things came together to create this sort of 2 or 3 day route in the volatility markets that, as you said, was kind of disentangled a little bit from what was going on in the S&P 500. So normally that sort of huge jump, normally what you think of is the S&P falls and then the VIX, or so the S&P falls and the VIX rises in response. Yeah. In this case, it was sort of the tail wagging the dog a little bit.
So there was a theory that you point out the theory back in 13 and 14 was that the S&P 500 was rising because of Fed liquidity, right? In other words, the only reason we came out of 08, 09 was because of Fed liquidity, and stock markets going up because of kind of this false liquidity. I'll quote out of your book here, quote, "If the markets were really inflated by the Fed's extreme money creation, then prices of commodities, goods and services and wages would have risen eventually." End quote. Obviously they didn't. Is price the best way to judge this? In other words, is that the only way we really have to kind of judge whether the policies of the central banks are wrong?
I mean, I suppose ultimately I agree with you that that it in a free market, it should be the tool that has the most information content. Absolutely. Yeah.
Yeah. So then you talk about in that, I think it was in that chapter, you then talk about you disagreed with that theory because it implied that the Fed has the ability, like God, to create real wealth. And I find that very interesting as just a subtopic because Ray Dalio is running around the world right now saying, oh, we've broken capitalism, and it's because the rich have got too rich and the poor aren't rich enough. And he's claiming that, in effect, if you read between the lines, he's saying that we have created real wealth. Now, I am more of the ilk of you where I say, well, the Federal Reserve has done something. It's called cause effects. The question is, what those people have attained, is it real wealth or is it a sawtooth pattern?
Yeah. So if you believe, in some sense, if you believe the prices of the S&P 500, the Fed's action has, created wealth in the sense that it's driven the value of the S&P 500 higher relative to, say, GDP than it would be not through anything aside from just money creation. And that seems like a magic trick. And so we would, argue that eventually you're going to see that reverse, and that wealth is not real. It's a function of essentially the Fed reducing volatility, which increases the value of carry trades, and the S&P 500 being kind of central to the carry regime, therefore, goes up in value.
And benefiting the people that can take upon them carry risks.
Right. So the people who are in a position to do carry trades tend to be wealthy and well connected. They start off with more capital than the average person, and if carry trades lose money when volatility goes up, and the Fed acts in those situations to stem the rise in volatility, in other words, to truncate the losses for carry traders, then you're basically subsidizing people who are wealthy, and you're reinforcing that existing difference, and it grows greater over time. So it's a fundamentally undemocratic process, and not one, again, that I think the Fed has intentionally tried to do.
Agreed.
But it's a second order effect that's become clearer and clearer over time, and one that I think they've kind of denied more than they should have. But yeah, it does increase wealth inequality in our view.
The Fed put theory, has touches in parts of your book as you talk about the S&P 500. Interestingly, I didn't see Jim Grant in your opening acknowledgments at all. Who, for listeners that don't know who Jim Grant is, he's written the Interested Observer, and that's where much of his fame. But he has a more recent book out there, Badget, that you can read. So I didn't see Grant in your acknowledgments. I saw Chancellor, John Authors, and Jeremy Grantham, though. If you look at the history of the Fed put theory, most people would kind of say it was actually 87. Greenspan lowered interest rates after the crash of 87 to provide liquidity, in effect. Isn't the only way the Fed put theory even possible is just in a bond bull market, which is the only place we've actually witnessed it in a meaningful way?
Yeah, that's first of all, yes, I agree with you about 1987, and then following on 1998 and 2008, obviously. But you make a very important point that the Fed put works in a deflationary world, right? Which is why it's so kind of dangerous right now that when the Fed intervenes to provide liquidity in a deflationary world, that supports the market. Now, in an inflationary world, the risk is that if we had, let's say, things get much worse in Ukraine, the market starts to go down, and the Fed feels it needs to intervene. Well, now you're intervening, you're flooding a market with liquidity when inflation is 7-8%. You've got supply, chain issues all around the world. Then all of a sudden people are like, hey, this isn't going to work. And if volatility doesn't fall after the intervention, then I guess really in some sense that's the theme of the book, that central banks seem like they have a lot of power right up until the moment where it's exposed that they might actually not have that much power.
Sure.
And that I think now is much closer to the situation we're at than even when we wrote the book.
Okay, so let's jump. Moneyness is a wonderful idea that you bring up in the book. So kind of briefly, can you describe moneyness briefly, and then I'm going to come back with kind of an example, and would love to have you react to my example.
Yeah, it's important always to remind me to be brief.
Well, myself included, so you're in good company.
No, that's fair enough. Look, the idea is that in a carry regime, right, carry is liquidity providing. So the world, as carry trades grow, the world is much more liquid. In other words, it's much easier to transact in the financial markets at low cost. Number one. Number two is interest rates are falling because debt is rising. So it's unattractive to hold cash because it doesn't pay much in the way of interest. Mm-hmm. At the same time, because markets are so liquid, a range of other assets start to be seen as almost as good as cash, as like mm-hmm. substitutes for cash. So think about fixed income ETFs. You can go buy a short-term bond ETF that pays a couple of % interest, and that looks like almost like cash, right? Because if you want to, sure. You need your money, you can sell. So the idea of moneyness is assets becoming to be seen as good as cash, because we're willing to overlook the risk that's embedded in them because volatility is so low. And then, of course, when you have 2008 or 2020, and we recognize that, hey, a short-term bond ETF is not the same thing as cash, I'm getting out and I'm going to move into true cash, then you get a kind of a run, exactly what we saw in the the ETF market in 2020, what we saw with money market funds in 2008. So moneyness evaporates during a carry crash, and the only thing that people really want to hold then is true cash.
On page 118 of your book, you had one of my favorite charts, and my jaw hit the floor when I saw this chart in there, because we came across this probably 6-7 years ago, and I use it in almost all my presentations, just so you know, Kevin. You show data from the Fed, and I know technically it's the St. Louis Fed. You show equities and mutual funds as a percentage of total U.S. household financial assets. You used it to explain how people are treating equities as though they are money-like, right? In other words, they're just willing to own a lot more of their net worth in stocks. I would add further to your case in your book, among wealthy people, they are creating credit from this moneyness, if you will. If you took $10 million to a brokerage firm today and said, hey, I have this stock portfolio, can I set up a loan account that's collateralized against that? They would give you 70%, up to 70% of the value of that portfolio that you could borrow at a very attractive interest rate, LIBOR plus something, okay? And what you could then do is go out and write an offer on a $3 million home for all cash. Isn't this just a perfect example of the moneyness we're talking about here?
Yeah, exactly. It's a kind of a shocking one. But yeah, I've got examples too where I have a lot of friends who manage portfolios for big institutions, endowments and foundations, et cetera. And they basically consider their S&P 500 exposure to be their liquidity pool, right? They don't hold cash. They just they hold liquid equities.
The other reason why I love that chart, just so you're aware, if you compare, and by the way, this completely fills in with your framework. It blew my mind in thinking about this. But we use that same chart. But then if you plot the 10-year forward returns of the S&P 500 on that data, what you'll find is the correlation coefficient is negative 0.85. So it's not a perfect relationship of, people's willingness to own stocks relative to their financial assets. It's just a really damn good one, but it's negative, right? So it actually is a contrary indicator. When people are treating stocks like money, you don't want to own stocks. And I think that really follows the pattern that you guys are laying out in this book, and the moneyness is just staring people in the face.
Yeah, no, it's I've seen that indicator as well, and it's about as high a negative correlation as you get. Certainly higher than even valuation indicators like, say, the Shiller's Cape ratio and things like that.
Agree. In fact, the data, just to make sure listeners understand, the data I think goes back to 1952 is where the St. Louis Fed goes back to. And I mean, in discussions, Kevin, in using your framework, it's perfect for this. I mean, this is the highest ownership we've ever had in U.S. history going back to 1952. And people think they're going to make money. So another conversation for another day, because I want to pivot. You say in the book, the over-levered world must be deflationary, and this is what you were just coming to a little while ago, and the under-levered world inflationary. Isn't that regime change what we've just witnessed post-pandemic from carry to anti-carry?
I'd say we're in the transition phase right now. We're definitely clearly transitioning to a world of higher inflation, and I don't think it's transitory. I don't know that we're yet in a world that's under-levered. But, if you think about it, you guys are, I believe you're stock pickers, right? You look for, company, you're not kind of shadow indexers, as far as I understand. So, in a world that's inflationary, highly inflationary, if you're a company, you might be thinking, shoot, I actually need more debt than I have because, that's gonna get inflated away. I can pay it back in 5 years at money that's worth much less than it is now. I don't think we're yet at that phase, but I could see those decisions starting to be, taken. So yeah, I think we're definitely transitioning out of the carry regime. But that, we say in the book, it's not going to be like a linear, smooth transformation.
Agree.
It will be choppy. It'll take time. Probably take one more big, I think, downturn in the market along the lines of what you and I just discussed. A downturn in the market where the standard playbook is all of a sudden destabilizing instead of stabilizing. So quantitative easing, flooding the market with liquidity in an inflationary world, that's not going to be stabilizing. It certainly shouldn't be stabilizing, right? So if you had a big downturn, people lose faith in the Fed. And also, I wrote an article about this about a year and a half ago. I think the expectation is, given that the Fed had bailed out the corporate bond market last time, that it should bail out equity holders, right? If I'm an equity holder, and as you said, most people are now, or a lot of people are, and the market's down 20, 30, 40%, and the Fed's not doing anything, and you're thinking, hold on, you bought mortgage bonds in 2008, you bought corporate bonds in 2020. How come everyone else is getting a bailout, not the equity holders? And then if the Fed doesn't, step in and directly support the equity market, then you've got a risk. And if it tries to support it indirectly through more quantitative easing, you've also got a risk because that's inflationary and inflation's already high. So I think we probably need some kind of episode like that before we're, fully transitioned out of the carry regime. Not to be like overly pessimistic. To circle back, I actually think the way to protect yourself is, a portfolio that's not just tracking the market, that's kind of smartly constructed in a way that maybe can take advantage of some of these things.
Well, Kevin, we know that we have one element that we typically need when carry ends, which is the Russian ruble is in full-on decline. I mean, that's the funny part. When we were talking about 98, I thought, wait a second. Yeah, we're definitely changing either a carry trade or a carry regime. We don't know yet, but the Russian ruble's doing what it should do. I really, it's funny, your book, as I read through it, I literally had, before you got to the inflation discussion, the under-levered discussion, in my mind I was thinking, but wait, inflation changes all of this. It really changes the modeling and the thinking and the psychology. Since people use the term climate deniers, I mean, the inflation deniers, who included the Fed, I would argue, now are in a regime that they hadn't built models for. Isn't this just a perfect negative liquidity price theory playing out in front of us?
Yeah, I think that's right. That's what we said the carry regime would have to end with higher inflation, and in fact, I think actually, Tim said that you might need some kind of supply shock to kind of really get it started, which
That's
we've
funny.
had. Yeah, so I completely agree.
The only part of your book that I think I wrestle with, because like I said, I really like the framework. I really liked a lot of the evidence you guys had, was, and by the way, I'm going to call this a Grantham-like idea, okay? It is kind of like the idea that a carry trade ends and then the economy is ruined because of it, okay? And now, for carry trades like '07 to '09, that's a good example of where the capital markets and the carry trade ending directly affected the economy, no question about that. But I don't think that's today's setup, as the problems that we're currently manifesting or seeing manifest in front of us are due to the economy, the unwillingness to borrow money relative to income among households, as an example, is different than it's been in the past. The demographics of places like the U.S. with consumers like millennials is different than we had in the prior 20 years, to your point kind of about how long this regime's been going on. So my last question is, does the economy have to be punished coming into this new regime, or is it maybe the winner in the anti-carry regime? And before I get your answer to that, I'm plagiarizing Buffett in his Sun Valley talk in '99. He used his, I don't know if you've ever heard of his talk, but he talked about 17-year cycles. He said 64 to 81 was where the economy got the capital, not the stock market. And he explained from 81 to 98, all the excess capital went into the stock market, kind of in a central bank kind of nod in some ways, not the economy. And so he's pointing out that stocks are going to do terrible from 98 to 15. And what I find interesting is this anti-carry regime, it feels, smells, looks like 64 to 81 did, and where the economy grew, but that's really all that grew, and money went into things like government spending and housing. Would you say the economy has to do terrible in every regime?
Well, I think we would say that long term, the ending of the carry regime should be good, because it channels money into kind of unproductive investment. And so if we can get away from that and get back to channeling money to more productive investment, then that should be good for economic growth.
Sure.
But there's going to be a transition period that could be quite painful. As you pointed out, the percentage of total assets in the stock market now is as high as it's ever been. So if you get a stock market significant correction and then doesn't bounce back, then that changes household balance sheets, changes the willingness to borrow. And I think there's a lot of leverage. The economy's leverage to the housing market, and then it's also leverage to the stock market as well. And there's interaction effects. I mean, I see people in my neighborhood, companies have gone public and they buy a house for cash, and they're 25 years old. And so that sort of thing would stop. So I think there's probably a transition period that isn't so great, but it could, hopefully we come out the other side to a more kind of sustainable pattern of growth,
To your
more
point.
equity financing versus debt financing.
Yeah, well, and stealing from the St. Louis Fed data, we've looked at home equity as a percentage of total net worth. And to your point, obviously, homes are going up in value, but actually right now we're at the average of the last 70 years in that statistic, which means we're just kind of at the middle ground. It's not overcooked and it's not undercooked. And I find that interesting because like 64 to 81, by the end of the 80s, everyone thought a house was the ultimate inflation protection, versus in the last 20 years, that wasn't true for those wealthy people. It was actually the stock market, to your point, in comparison. So I just think all the topics we covered, Kevin, and it's like my mind, I'm having too much fun. So that probably means we probably need to do something else with our lives. Is there anything else that we haven't talked about in our discussion about your book with Tim and Jamie that you think needs to be mentioned?
Well, that's a good question. We've covered a lot of ground, and I do want to circle back because I feel like sometimes I come across as sort of too pessimistic, and I try to be an optimist, and I'm an optimist by nature. But I think the way forward is to, it's kind of like, what's the line from A Few Good Men? You want the truth, you can't handle the truth.
Yeah.
Let's handle the truth. So this is just kind of like, I think, a more accurate description of the way the economy is behaving. It does mean there's risks out there that I don't think the central bank has fully appreciated. I do think that we need a kind of rethink of kind of what the central bank's role is in the economy, because if we're now in a world where, the kind of asset-based economy, and the central bank has to support the asset markets in a way that it didn't when it was imagined in 1907, then we ought to charge for that. I think there ought to be, if the Fed is the liquidity provider of last resort, I'd like to see it. I'd like to see a charge for that explicitly.
But at what price? Yeah. It's the liquidity provider of last resort, but at what price is what you're getting.
Exactly, yeah. And hopefully that's something we can address in our second book. And people aren't going to like it, because anything that they've previously gotten for free, when you have to start paying for it, we don't like it. It's like we've got carbon, we've got to use carbon for free for our whole lives, and now people want to put a price on it. We're not happy about it. But I think that needs to happen, and I think to the extent the Fed's been trying to provide insurance, kind of like trickle down insurance, right? Let's prevent people from losing their jobs by supporting the bond market, and that's like trickle down economics. There's no empirical support for it. So to the extent we want to insure things, let's insure them directly. That cost will be up front, and then let markets kind of be freer to set prices, as you and I both said, because we want prices to be informative of things. So I'd like to hope that in the next 10 years we can rethink the type of insurance we want to provide and how we're going to charge the people who are getting that, and let financial markets be a little less governed by central bank movements.
Which also means that for people that haven't lost their mind with their capital, there could be increasing returns, versus people that have lost their mind, there could be decreasing returns, which I love the sound of that, to be honest. Well, Kevin, this has been just a wonderful conversation. I really appreciate your time personally. As I said earlier, The Rise of Carry is a great book for building a framework for where we are. Like Kevin and I talked about as we speak, I believe it explains the transition we are seeing in interest rates, stocks versus commodities, capital versus labor. If I were you, I'd go out and buy a copy of it. And thank Kevin so much for his time, and thank you also to Tim and Jamie for this work. For our listeners, if you have a great book that you'd like to recommend, email podcast@smeadcap.com. That's podcast@smeadcap.com. Thank you for joining us for A Book with Legs podcast. We look forward to the next episode.
Thank you for listening to A Book with Legs, a podcast brought to you by Smead Capital Management. The material provided in this podcast is for informational use only and should not be construed as investment advice. You can learn more about Smead Capital Management and its products at smeadcap.com or by calling your financial advisor.